One of my jobs as a Treasuries trader is to try and profit from artificial dislocations in the marketplace. An example of this is selling duration on month end, hoping that yields will rise ahead of NFP. Okay, what exactly does that mean? I'm going to break it down into three parts. First, selling duration on month end. Second, hoping that yields will rise. And third, into NFP. Selling duration on month end occurs when index funds are forced to rebalance their funds to a benchmark index on the last day of every month. This usually means that they are forced to buy bonds into the 3 p.m. close on month end. Now, as a bond trader, I'm sitting there thinking, these guys are forced to buy bonds into 3 p.m. on the last day of every month. This would be a great opportunity to make a sale. This is an artificial dislocation in the marketplace. Now, I want yields to rise after I've made this sale. But why is that? I've just sold the thing. Don't you usually want things to go down after you've sold them? Well, in this case, yields and prices are actually inversely correlated. So when yields go higher, prices actually go lower. And so given that I sold at a higher price, I want the bond's price to go lower such that I can buy it back and lock in a profit. Now, why do I think that yields will go higher? Well, that's where the NFP part comes into play. On the first Friday of every month, the federal government releases the non-farm payrolls report, which basically is the most important economic indicator on a month-to-month basis. Now, traders like myself are looking at this to see how the economy and the job market is doing, but more importantly, the Federal Reserve is also looking at this number in order to influence how it decides to engage in monetary policy. Now, over the past few years, the Federal Reserve has engaged in extremely easy monetary policy. They've artificially kept bond yields low by buying a massive amount of bonds in the open marketplace. So over the past year, as the economy has gotten better and better, one fear in the marketplace is that the Fed will stop buying as much as they have been buying. And therefore, yields will no longer be artificially suppressed lower and they'll go higher. And so ahead of every report over the past few months, yields have drifted higher in fears of an extremely good jobs report that would cause the Federal Reserve to taper their bond purchases. And so you sell on month end where there's an artificial buying flow, hoping that yields will go higher, prices lower, and you hope to buy them at a lower price and make a profit on that sale. Now, life isn't so easy and it won't always work out in that way, but that's the main thesis behind the trade idea.